Did you know that every rupee you earn and every rupee you spend is taxed? But have you ever stopped to think about how and why these taxes exist? More importantly, are you unknowingly paying more tax than you should? Today, we are going to unravel the mystery of direct tax versus indirect tax. And by the end of this video, you will not only understand how they impact your life, but also how to make smarter financial decisions. Let's dive in. Taxes aren't just numbers deducted from your salary or extra charges on your restaurant bill. They shape economies, impact businesses, and define financial freedom. But here's where it gets interesting. Some taxes you see, while others you don't even realize you're paying. Let's say you earn 1 lakh a month. Before it even reaches you, a portion is taken as income tax, a direct tax. Now you go shopping, buy a smartphone and pay GST and indirect tax. The government is collecting money at both ends, but the mechanics of these taxes are vastly different. The question is, which tax system is fairer and how can you navigate it smartly? A direct tax is exactly what it sounds like. A tax that is directly imposed on individuals or businesses with no middleman. These include income tax, tax on your salary, business profits or capital gains. Corporate tax, the tax paid by companies on their earnings. Wealth tax, now abolished, a tax that was levied on individuals' total wealth. Unlike indirect taxes, direct taxes are progressive, meaning the more you earn, the more you pay. The logic, it helps redistribute wealth and funds essential services like healthcare and education. One of the biggest direct tax cases in India was Vodafone International Holdings versus Union of India. Vodafone acquired Hutchinson SR for 11 billion, but the Indian government demanded capital gains tax. The Supreme Court ruled in favor of Vodafone, stating that transactions outside India should not attract Indian tax laws unless clearly defined. This case reshaped tax policies for foreign investments in India. Lesson: not all tax laws are black and white. Understanding them can save you from unexpected liabilities. Now, here's the trickier part: indirect taxes. These are collected from you when you buy goods and services but are not paid directly to the government. They include GST, Goods and Services Tax, the most common indirect tax on goods and services. Customs duty, paid on imports and exports. Excise duty, pre-GST, previously levied on the manufacturing of goods. Unlike direct taxes, indirect taxes are regressive. Everyone pays the same rate, regardless of income level. Whether you earn 20,000 rupees or 2 lakhs a month, you'll pay the same 18% GST on a new phone. A crucial indirect tax case was Gannon, Dunkerley and Company versus State of Rajasthan. The Supreme Court ruled that sales tax cannot be levied on a works contract unless it specifically involves the sale of goods. This ruling later influenced how GST was structured in India, making taxation clearer for businesses. Lesson: understanding indirect taxes help businesses and consumers avoid overpaying and take advantage of available exemptions. Which tax system is better? Neither system is perfect. Indirect taxes ensure that the rich pay more, but they are often evaded through loopholes. Indirect taxes are harder to escape, but they burden lower income groups more than the wealthy. So, where do you think we stand? Should India rely more on direct taxes or indirect taxes? Let's look at the numbers. Indirect tax collection has surged past 16 lakh crore in the recent years. Indirect taxes, especially GST, contribute nearly 50% of the government's total revenue. The key takeaways: it's not about one being better than the other, it's about balance. How to navigate the tax system wisely? First, for salaried individuals, file your income tax returns or ITR on time to claim deductions. Use tax saving instruments like PPF, ELSS and NPS to reduce taxable income. 2. For business owners and freelancers, Keep track of GST input tax credits to reduce cost. Structure your income smartly to minimize tax liabilities. 3. For investors, understand capital gains tax. Investments held more than a year enjoy lower taxes. Real estate and stock market gains have different tax treatments. Be aware. At the end of the day, taxes reflect our choices, our priorities, and our contribution to society. They fund the roads we drive on, the hospitals we rely on, and the infrastructure that fuels progress. But understanding how they work isn't just for accountants. It's for everyone who wants to make a smarter financial decisions. So, the next time you check your payslip or buy something at a store, take a moment to think how much of what you earn and spend is actually yours? And more importantly, how can you legally and ethically optimize it? If this video gave you the clarity on taxation, make sure to like, share and subscribe to my channel for more legal and financial insights. And if you want to dive deeper, check out my playlist on laws in India. The link is in the description. Let's make legal knowledge simple and accessible for everyone. Thanks for watching. Take care. Bye.
Living life